Good morning, students. Today we are going to take up the second part of the second chapter of Commerce, class 12, that is capital structure. Capital structure means the type of securities to be issued and the proportionate amounts that make up the capitalization. It refers basically to the proportion between owned funds and borrowed funds that a company can use to make up its capital. The next part relates to the factors affecting capital structure. Number one, trading on equity. A very important aspect with respect to capital structure. When a company uses borrowed funds, that is loan funds, in regular conduct of business along with equity capital to generate profitable returns for equity shareholders, it is said to be trading on equity. It is usage of cheaper sources of finance to increase earning per share. It is basically a trade-off between risk and return. A typical trading on equity has two main implications. Number one, use of fixed charge securities like debentures, preference shares will increase return to equity shareholders only if rate of fixed charge is lower than the return on investment. Number B, use of fixed charge securities involves risk and threat of insolvency, that is bankruptcy or closure of the company, as debt has to be repaid along with interest even when the company is in loss. Next, trading on equity is desirable only when number one, rate of earnings is greater than rate of interest and preference dividend. Number B or number two, company's earnings are stable and regular to pay at least the interest on debentures. And number three, there are sufficient fixed assets to offer as securities to lenders. Number two, exercise of control. Equity shareholders control the company as they have voting rights and the say in the management. But if promoters of the company want to retain control in their hands, then they will always prefer issue of preference shares or debentures. Number three, flexibility. Capital structure must not be inelastic. It must permit changes in future. A company may initially issue equity shares, but at the time of future expansion, it may issue debentures and preference shares, as these can be redeemed as per terms of issue, and also voting rights can be retained in the hands of the promoters. Number four, nature of business. The nature of business enterprise determines different sources of finance. Companies enjoying regular and liberal earnings can afford more debt capital, that is a high capital gearing ratio with more debt and less equity, while business firms which are subject to wide fluctuations in demand may find it safer to depend more on equity capital, that is to have a low gearing with more equity and less debt. Next, cost of financing. One of the most important aspects of capital structure. Cost of capital depends on the current rate of interest payable, expected return by the potential investors, and flotation costs. The cost of raising finance must be estimated, and thereafter a judicious mix of varied sources of finance is to be determined, which must help in minimizing cost of capital and maximization of the wealth of the equity shareholders. Next, statutory or legal requirements. Provisions of Companies Act 2013, SEBI guidelines and other state regulations need to be taken into consideration before formulating a capital structure. Next, period and purpose of financing. Long-term finance may be raised through equity shares and retained earnings, whereas short-term or medium-term finance may be raised using preferentials, debentures, and loans. Next, capital market conditions. During boom, investors are willing to take risk and so they invest in equity shares. While at times of depression, investors prefer safer investments like fixed income bearing securities, example preferentials and debentures. Next, cash flow position. The ability to generate enough cash flows to meet its fixed commitments like interest payments influences capital structure decision. A company must analyze its liquidity position and prepare projected cash flow statements before deciding debt equity ratio. Finally, need of investors. Conservative investors prefer debentures as it gives safe returns, whereas enterprising investors who are ready to take risks and are willing to get more returns will always prefer investment in equity shares. I hope every one of you have understood the factors affecting capital structure and what is capital structure. If you have any question regarding this video, please put it in the comment box of this video.